Stop what you're doing for the next minute because the silver story just took a turn that most people will miss until it's too late. While everyone argues about stocks, politics, and the next headline, something quieter is happening. Silver is being treated less like a metal and more like a target. And if you're only watching the price chart, you're watching the shadow on the wall, not the thing casting it. Quick note before we go deeper. YouTube stats show a lot of you watch these videos, but haven't subscribed yet. If you want me to keep breaking this down in plain language, hit subscribe right now so you don't miss the next update. All right, I'm recording this on Friday, January 23rd, 2026, and the exact time on my clock is 8:43 a.m. here. Comment below what time you're watching because I love seeing how global this community is. And also check the description after the video because I've dropped bonus links there, including a premium WhatsApp channel link and a channel membership join link. Now here's the part that should bother you. A Dutch silver museum reportedly woke up to a nightmare. Cases emptied, shelves stripped, and hundreds of historic silver pieces gone in minutes. Not a few items, an entire collection, like someone hit select all on history and dragged it into a black bag. And as silver prices get louder, that kind of theft doesn't just steal objects, it steals signals. Because when criminals move fast, they're reacting to incentives. And incentives change when markets shift. But don't let that story distract you from what's happening in the financial markets right now, because the market tape is basically screaming two messages at the same time. One message says everything is fine. The other message says something is cracking under the paint. So let's do what most people won't do. Slow down, look at the moving parts, and then put them back together in a way that actually makes sense. First, the broad setup. When yields creep up, the dollar usually gets a tailwind. When the dollar gets a tailwind, precious metals usually get a headwind. That's the textbook. But here's what makes 2026 weird. The textbook is still on the table, yet the room has changed. We're seeing days where bonds wobble, equities smile, the dollar slides, and metals refuse to collapse. That combination is not normal behavior. It's the market telling you that the old one lever controls everything model is losing power. And I want you to lock in on that phrase, losing power, because silver, more than almost any other asset, is about power. Literally electricity, conductivity, grid upgrades, solar, electronics, sensors, medical equipment, data centers. And then in the same breath, silver is also about trust. Coins, bars, savings, the thing people touch when they don't trust screens. That dual identity is why silver is so dangerous to misunderstand. Here's a simple way to picture it. Gold is like a fireproof safe. Silver is like a fireproof safe that also happens to be a toolbox. People want the safe when they fear a house fire. Industry wants the toolbox when it's building the house bigger. If both groups reach for the same object, you don't get calm price discovery. You get friction, and that friction shows up in weird places first, like premiums, delivery timelines, lease rates, and sudden disappearances of inventory that nobody wants to talk about loudly. Most people never look there. They just stare at a spot quote on a screen and assume that screen is the whole truth. It isn't. Now let's talk about the day-to-day price action because a lot of people panic at the wrong moment. You'll see silver dip hard during US hours, and then it stabilizes, sometimes even rebounds as Asia comes online. People try to narrate that like a cartoon. America sold, Asia bought. Sometimes that's true, sometimes it's lazy storytelling. But the pattern matters. If price drops are being absorbed quickly, that tells you the market is not just trading paper promises. It's bumping into real demand that doesn't disappear just because a headline changed. And that's where the physical versus paper tension comes in. Futures markets can move price with speed and leverage, but physical markets move price with stubbornness. Leverage can push price down in a rush. Stubbornness can pull it back up slowly, like a heavy door closing on a windy day. You can slam it open, but you don't get to decide whether it stays open. Now, here's a cliffhanger you need to sit with. What happens when the stubborn side gets more stubborn? At the exact moment the leverage side gets more fragile, because that's when you stop getting clean dips and rebounds and you start getting gaps. And gaps are where people lose sleep. Let's take a step back and ask a more important question. Why is silver suddenly in the spotlight at all? For years, silver was treated like the awkward cousin of gold. It got invited to the party, but nobody asked it to speak. That's changing, and not because the internet decided it's trendy. It's changing because the world is rebuilding itself, and silver is baked into that rebuild. Think about the modern economy like a giant renovation project. You don't renovate a house without copper wiring and reliable connectors. You don't modernize a grid without conductive materials. You don't scale solar without the stuff that turns light into usable current. Silver is used in solar cells, electronic solder, contacts, and a long list of components that aren't optional if you want the tech to work. A typical solar panel uses only a small amount of silver measured in fractions of an ounce. And manufacturers have worked for years to thrift that amount down. But here's the catch. When you multiply a tiny amount by hundreds of millions of panels, the total becomes massive. And if installations keep climbing, the industry can thrift per unit and still consume more metal overall. That's why demand trends matter more than a single engineering headline about using less. Then there's EVs and charging, even if the silver per vehicle varies by design and component choice. The ecosystem around electrification eats silver. Power electronics, high reliability contacts, charging hardware, grid interconnects, and sensors. Silver isn't there for decoration. It's there because failure is expensive. And conductivity plus corrosion resistance buys reliability. And it's not just energy. Silver is antimicrobial, which is why it shows up in medical coatings, wound dressings, and some water filtration technologies. It's in RFID and switches, in high-performance bearings and pastes, and in the invisible parts of devices that have to work for years without drama. When you add all of that up, you realize silver demand doesn't rely on one gadget or one trend. It's spread across the plumbing of modern life. Now here's the trap. People hear industrial metal and assume that makes silver less valuable as a store of value. But that's backwards. Industrial demand doesn't weaken silver's monetary side. It competes with it. It puts a floor under it. It means silver isn't just sitting in a vault waiting for a mood swing. It's getting consumed. Consumed is the key word. Gold mostly gets hoarded. Silver gets used, scattered, and partially lost. Some of it is recycled, sure, but a lot of it ends up in tiny quantities spread across devices, where it's not economical to retrieve. That's not a conspiracy. That's just physics and economics. And historically, this isn't new. Silver was money for thousands of years. Entire empires ran on it. People forget that many currencies were effectively silver promises long before they became pure paper. In the United States, silver coins circulated widely until debasement and removal from everyday coinage made the metal vanish from pockets. That wasn't because people stopped liking silver, it was because the metal became more valuable than the stamped face value. And the moment that happens, coins disappear. So when people say there's plenty of silver, what they often mean is there was plenty of silver when nobody wanted it this badly. Now let's connect this to the market narrative floating around tariffs. When policymakers hint at easing trade tension, markets often interpret that as less inflation pressure, less supply shock, and less urgency. That can trigger selling in metals, especially the metals tied to manufacturing like copper and silver. But here's what I want you to remember. Headlines can shift expectations for a week. Infrastructure needs can shift demand for a decade. And that's why you can get violent selling on a headline followed by a calm bid underneath. The fast money sells the story. The slow money buys the reality. But I'm not going to pretend the reality is simple. It's not. Silver sits inside a three-way tug-of-war. Monetary fear, industrial hunger, and speculative leverage. Sometimes the fear drives it. Sometimes the hunger drives it. Sometimes the leverage drives it and then punishes everyone when it unwinds. So if you want to understand silver, you don't just watch the silver chart. You watch the pressure points around it. One of those pressure points is copper. Copper is the bloodstream of electrification. If copper supply tightens, manufacturing costs rise. If manufacturing costs rise, substitution happens in some places, but not everywhere. And because a large portion of silver supply comes as a byproduct of mining other metals, including base metals, constraints in base metal mining can indirectly squeeze silver supply too. Here's the part people miss. Silver miners are not the only source of silver. A lot of silver is produced because someone wanted something else. That means silver supply can be surprisingly sticky and slow to respond to price. Even if silver becomes more profitable, you can't instantly turn on production if the primary mine economics are tied to zinc, lead, copper, or gold. So when silver demand accelerates, the supply response can lag. That lag is where volatility lives. Now you may hear people claim that China determines the price. Now I'm going to challenge that. China is a major demand center. Yes, Shanghai pricing can reflect physical appetite. Yes, but global pricing still gets heavily influenced by Western futures liquidity, by ETF flows, by currency moves, by interest rate expectations, and by the risk on or risk off mood in equities. In other words, it's not one city holding the steering wheel. It's multiple hands fighting over it, and sometimes the car swerves. That's not a bearish statement or a bullish statement, it's a realism statement. And realism helps you survive. Now back to that museum heist because it matters in a way people don't want to admit. When a valuable object becomes easier to sell, the incentive to steal it rises. But when the object is not just valuable, but also liquid, portable, and globally recognizable, it becomes a criminal's dream. Silver checks those boxes. Historic silver, especially, can be melted, altered, or moved quietly. So, the theft isn't just about art, it's about a market signal. More people believe silver will hold value tomorrow, and that belief is the fuel that makes a market go from quiet to chaotic. And that psychological shift has a habit of spreading. Let's talk about the Goldilocks idea people throw around with silver. The reason it resonates is simple. Silver can behave like a productivity metal when the world is building, and like a protection metal when the world is panicking. It's not locked into one personality. And that flexibility is why silver can explode when conditions align. But flexibility cuts both ways. Silver can also get punished when traders want to de-risk quickly. Because silver is smaller than gold and more volatile, it becomes the first target when big players need liquidity fast. That's why you can see silver fall harder than gold on ugly days, even if the long-term story hasn't changed. So the question isn't, is silver good? The question is, what phase are we in, and what kind of participant are you? If you're a short-term trader, you care about momentum, positioning, and catalysts. If you're a long-term holder, you care about the slow grind, supply constraints, industrial adoption, currency debasement, and how trust is shifting in the world. And if you're somewhere in the middle, you have to balance both without letting either one wreck your plan. Now here's another cliffhanger. The next big move in silver might not start with silver. It might start with something that looks unrelated, like a sudden wobble in credit markets, or a sharp move in energy, or a surprise inflation print, or a geopolitical flare that forces supply chains to reroute. Silver doesn't need to be the first domino. It just needs to be one of the dominoes that has both industrial and monetary weight. So what should you watch? Watch real rates, not just nominal rates. If inflation runs hotter than yields, the real return on cash becomes negative, and that environment tends to push people towards scarce assets. Watch the dollar, yes, but also watch how confident the market is about central banks being in control. The moment confidence fades, gold usually moves first, and silver often follows with more violence. Watch energy prices, because energy is the hidden tax on everything. When energy rises, costs rise, and that can strain the system. But energy also influences mining margins and production decisions. Higher energy can slow supply growth. Lower energy can ease pressure, but also boost industrial demand. Either way, energy matters. And watch the stock market mood. When equities feel invincible, metals can feel boring. When equities feel fragile, metals feel like an exit door. Now, I want to introduce a community element right here because this matters. If you've had any kind of success, whether it's stacking, trading, investing, starting a side hustle, anything, share your success story in the comments. It keeps people motivated, and it helps newer viewers see what's possible when you stay disciplined. All right, let's zoom into the silver supply-demand mechanics because this is where a lot of viral myths live. Myth 1, there's plenty of silver above ground. The truth is complicated. There is silver above ground, yes, but how much is available at current prices? That's the real question. A metal can exist and still be unavailable because it's sitting in products, in private holdings, in industrial inventories, and in places where it won't come to market unless price is high enough to force it out. So, availability is not the same thing as existence. Myth 2, higher price will instantly create more supply. Not instantly. New mines take years to permit, fund, and build. Even expansions take time. And because so much silver is byproduct, the supply increase depends on the economics of other metals. If base metal demand slows, silver supply can slow even if silver demand rises. Myth 3, silver is just a cheaper version of gold. No, silver is a different beast. Gold is mostly monetary and jewelry. Silver is monetary, industrial, and consumable. That makes silver's price behavior more chaotic, but also gives it more pathways to upside. Now, if you're thinking, okay, so where does that leave us today? Here's the honest answer. The market is in a tug-of-war, and the rope is fraying. You can see it in the intraday whipsaws. You can see it in how dips are being bought. You can see it in how quickly narratives shift from silver is dead to silver is unstoppable, and back again. That kind of emotional volatility usually happens near inflection points. And I'm not saying we're guaranteed to be at a top or a bottom. I'm saying the conditions are right for surprise, and surprise is what creates the biggest moves. Now let's bring in the macro calendar for a second. When GDP revisions, inflation prints, and jobs numbers hit the tape, they don't just move markets because of the numbers. They move markets because they change the story. The story drives positioning. Positioning drives flow. Flow drives price. And price drives headlines, which feeds the story. Again, it's a loop. And here's where the ratios come in, because ratios tell you what a single price can't. If you only look at silver in dollars, you're judging the metal through the lens of the very currency people are worried about. But when you compare silver to gold, silver to copper, and silver to energy, you start to see when silver is cheap or expensive relative to the real world. Historically, the gold to silver ratio has swung like a pendulum. In some eras, it's been compressed when silver is beloved, and in other areas, it is stretched when silver is ignored. When that ratio stretches too far, it usually doesn't stay there forever. It snaps back. And the snapback can happen even if gold is rising because silver can rise faster. Now, I'm not telling you a ratio is a magic trigger. A ratio is a temperature gauge. It doesn't cause the fever, but it tells you when the body is overheating or freezing. And right now, the ratio conversation is returning because more people are realizing silver isn't just gold's sidekick. Silver has its own demand engine, and that engine doesn't ask permission from sentiment. Another angle is inventories. People love to argue online about how many ounces are out there. But the more useful question is how many ounces are sitting in a form that can be delivered without blowing out spreads. When inventories are comfortable, the market can absorb shocks. When inventories are tight, the market becomes jumpy, and the tiniest spark can create a bigger fire than anyone expects. And this is where I'll challenge another comfortable belief. If silver spikes, substitution will save the day. Substitution is real, but it's not instant and it's not free. Engineers don't redesign supply chains overnight. Certifications take time. Reliability testing takes time. And in sectors where failure is catastrophic, power systems, medical systems, defense-grade electronics, companies pay up for what works. They don't gamble to save a few cents. Now, the skeptical crowd will say, okay, but what about crypto? What about tokenized everything? What about digital gold? Here's my counterpoint. Digital assets can be useful, but they don't conduct electricity. They don't get soldered into a circuit, and they don't get used up by industry. They can compete with the monetary story, but they can't compete with the industrial story. And when one asset has two demand engines, it doesn't need to win every debate to win the trend. So keep your eyes on the structure, not the noise, because the market rarely announces the real shift with a clean headline. It whispers it through weird behavior first, and then it shouts it later. So if we get weaker growth with sticky inflation, that's a nasty mix for cash. If we get stronger growth with easing inflation, that can calm metals temporarily but fuel industrial demand. If we get volatility and uncertainty, that's usually when silver starts acting like it has something to prove. Now let's talk about tariffs and trade narratives again, but deeper. Even if some tariffs are softened, the world is still moving toward redundancy. That means supply chains are being rebuilt with resilience in mind. Resilience is expensive. Expensive means more capital spending. More capital spending means more materials demand. Materials demand means metals demand. That's a slow-burning tailwind for silver, copper, and other conductive metals. And here's where I'll add something not enough people consider. The energy transition isn't just about cars and solar panels. It's about data. Data centers, AI compute, networking, cooling systems, sensors, and hardware scaling. Every wave of digitization has a material footprint. The cloud is not weightless. Its warehouse is full of machines. Machines need metals. Now, I want to drop a practical question for you. Do you think the world is going to use less electronics 5 years from now or more? Answer honestly, and then ask yourself what that implies for a metal that keeps the electrons moving. Comment your answer below, because I read these and I want to see how you're thinking about this. Now, let's pivot to gold for a moment, because silver doesn't live alone. Gold is the gravity in the precious metals universe. When gold is calm, silver can still move, but gold sets the emotional baseline for the sector. When gold starts trending, silver often turns into a multiplier. And here's the interesting thing. When you see gold holding up during moments when it should be weaker, like when yields are up, that can signal underlying demand that isn't just speculative. That could be long-term allocation shifts, institutional hedging, or global buyers diversifying away from currency risk. You don't have to believe any single narrative. You just have to recognize that price behavior is information. Now, some people are obsessed with central bank behavior. I'll keep it simple. Central banks have strong incentives to diversify reserves, but they also move in cycles and sometimes pause. The key is that gold remains a global settlement asset in a way nothing else does. Silver is not the same in that regard, but silver benefits when trust in paper assets gets questioned, because silver is the accessible hard asset for a lot of people. So even if gold is the central bank asset, silver can be the crowd asset. And crowds matter when the supply is tight. Now, I promised you retention, so here's a cliffhanger you should Remember the next time you see a boring day on the chart. The biggest silver moves often start after the market convinces you nothing will happen. It lulls you, it compresses, it shakes out impatient hands, and then it breaks. So, if you're watching silver every day and you feel numb, be careful. Numbness is how markets set traps. Now let's talk about miners and production for a moment, because a lot of people treat miners like a simple leveraged play on metal prices. That's partially true, but miners are also businesses with costs, timelines, political risks, and management decisions. When metal prices rise, miners can benefit, but only if they control costs, maintain grades, and avoid disruptions. In recent years, a lot of miners have focused on discipline, paying down debt, returning cash to shareholders, and developing projects more carefully. That can be boring in the short term, but it can be powerful over time if the metal price cycle turns in their favor, and this is where energy comes back into the story. Energy costs hit mining margins directly. If oil and fuel rise, mining costs rise. If mining costs rise while metal prices stay flat, margins compress. But if metal prices rise faster than energy, margins can expand dramatically. So you can think of energy exposure as both a risk and a hedge, depending on how you structure your portfolio. Now here's a storyline that doesn't get enough attention. Silver is one of the few assets where the value story and the use story can reinforce each other. If silver gets recognized as a better store of value, people hold more of it, reducing available supply. Reduced available supply increases sensitivity to industrial demand. Increased sensitivity creates sharper price moves. Sharper price moves attract attention. Attention attracts more buyers. That's how reflexivity works. It's not magic. It's feedback loops. But feedback loops can reverse too, and that's why risk management matters. Now, if you want to learn silver-related success stories, the link is in the description. Subscribe there too, and see how people made money and how they manage the emotional side of these moves. Sometimes the best lesson isn't a chart, it's how someone kept their head when the chart tried to steal it. And speaking of lessons, let's talk about the museum theft again, but from a market psychology angle. When something becomes both valuable and scarce, the world splits into two groups. Group 1 says, that's too risky. Group 2 says, that's exactly why I want it. The second group often ends up driving the trend because they act while the first group hesitates. Silver has been in that transition zone for a long time. It was ignored, which made it safe to ignore. Now it's being noticed, which makes it dangerous to ignore. And when an asset crosses from ignored to noticed, volatility usually explodes. Now some of you are thinking, okay, so what's the play? I'm not here to tell you what to buy. I'm here to help you see the chessboard. Your job is to decide your moves based on your situation, your risk tolerance, and your timeline. But I can tell you what I'm watching. I'm watching whether sell-offs keep getting bought quickly. I'm watching whether silver holds key levels after volatility spikes. I'm watching whether industrial metals stay supported even when macro headlines swing. I'm watching whether the dollar can actually sustain strength or if it keeps fading on rallies. And I'm watching whether the market starts pricing in the return of an environment where cash pays you less than inflation takes from you. Because in that environment, people get creative. They look for exits. They look for stores of value. They look for yield. They look for anything that doesn't feel like a guaranteed slow leak. Now here's another community moment. If you're successful in any way, again, trading, stacking, business, career, share it in the comments. Somebody reading your story might be one bad week away from giving up, and your story might keep them going. All right, let's address one more controversial idea. The price rise is designed to force silver out of people's hands. Sometimes people talk like there's one mastermind pulling strings. I'm skeptical of that framing. Markets don't need a single puppet master to create pressure. Leverage, incentives, and crowd psychology can create the same outcome without a central planner. Could large players attempt to influence narratives? Sure. Do media cycles exaggerate certain risks? Absolutely. But the bigger force is structural. When demand rises and supply is slow, the price has to do the work of rationing. That's not a plot. That's how commodities balance. So instead of assuming a villain, focus on the mechanism. Price goes up to reduce consumption or increase supply. If consumption can't drop easily because the metal is essential, then price has to rise more. If supply can't rise quickly, price has to rise more. That's the math. Now, what about the broader economy? Here's where I want you to be careful. There's a tendency to think in binaries: recession or boom, risk on or risk off. The real world is messier. You can have parts of the economy slowing while other parts accelerate. You can have consumer strain while corporate profits hold up for a while. You can have inflation falling in one basket and rising in another. That complexity is exactly why silver's dual identity matters. Silver can benefit from growth spending and also benefit from fear hedging. It can get hit in a liquidation event and then recover if the underlying demand remains. It's not a straight line. Now, I need to do a quick members note because a lot of you have asked for deeper dives with more charts and more scenario work. We offer members-only videos produced by a separate research team that goes heavier on data comparisons and deeper context. Those videos are only for premium members, and the join link is in the description if you want that extra layer.